works is that with chapter 6, the way it works is that we do not update the sales, we do not update the inventory with every single sale. At the end of the period, we do calculations in order to figure out the cost of the inventory. So we do the cost of the inventory, and or normally we do cost of goods sold as well, but you may get some problems where they'll ask you for one or the other. Okay, so that's what this chapter is going to be about. Now, in this chapter, we have the first part's about classifying and determining inventory. Then we'll look at inventory costing. So if we look at the inventory costing, we look at the screen here. The first one's called specific identification. That one, we're going to spend a little bit of time on it, super quick. There will be nothing in the homework and nothing on the exam for specific identification. Okay, it's very easy, and I'll show you that. Then we will get into the cost flow assumptions. We will spend the majority of the time in the cost flow assumptions. That's where the majority of the second part of the class will take place. And the cost flow assumptions are LIFO, FIFO, and average costing. And LIFO and FIFO are not poodles. They are last in, first out, and first in, first out. So that's LIFO, L-I-F-O, and FIFO, F-I-F-O, okay? So we'll learn about the cost assumptions. Now today we will get through FIFO, first in, first out. On Wednesday, we will do last in, first out, and then we'll also cover the rest of this stuff here, which this is actually really quick stuff to go over, okay? So let's see. So we're going to first talk just really quickly about merchandising versus manufacturing. Now, in this class, you deal with service companies, which we did chapters 1 through 4, and then you deal with merchandising companies, which we did in chapter 5. So merchandising is selling an actual product, right? Now, we also have companies that may be making their product from scratch, and those would be manufacturing companies. So when you have manufacturing companies, your inventory is actually classified into 3 sections. So let's say that you were going to make Coca-Cola, right? Your raw materials would be sugar, coloring, carbonated water or carbonation water, aluminum for the cans, ink to print the cans. Those would all be your raw materials, okay? Another phase of the process, which could be inventory costing, is work in progress. So this might be where maybe you have all the cans made, or you have all the soda mixed up, but you don't have it in the cans yet. So you would have different costs associated to where they were in the process. And then you have a cost of inventory for finished goods. So depending on where things are in the process of being manufactured, you have different costing according to the different areas. You will not work on that in this class. That is something that will come later in accounting, but it's something that we just mentioned here, just so you're aware that there is a difference between actual manufacturing versus merchandising, which is selling. So usually it's like, you buy 100 widgets for $10 each, and then you sell those widgets for $15 each, right? That would be more merchandising. Okay, so we looked at, in chapter 5, we looked at the perpetual inventory system, and that's where we actually update the sales every time. We update the inventory every single time we make a sale. Every time we make a sale, we update the inventory. That is called a perpetual system, okay? It perpetually updates. We then do inventory counts periodically in order to check to make sure that things are accurate. With a periodic system, we determine the inventory on hand and we determine the cost of goods for the period at the end of the period. And that's what this chapter is all going to be about. Inventory costing is going to look totally different than anything you've done. So be patient with yourself. I'm going to be giving you some tools to help you to learn how to do this. And you just have to kind of bear with it, go through the process, and then you're going to have to practice and you really have to follow the rules. We're getting to that point in accounting now where you're going to get a lot of problems that are going to have like a lot of steps and a lot of rules. It's going to say, if it's this, do this. If it's that, do that, kind of thing. So you have to be, this is where the critical thinking comes in. You have to be very methodical and very deliberate and read the instructions really clearly. Okay, so taking a physical inventory count, they're just kind of talking about how they often do it when businesses are slow or closed at the end of the accounting period. Now, we already talked about this. We talked about determining ownership of goods. We talked about FOB destination and FOB shipping point, and who actually legally owns the goods depending on the shipping method. Well, the reason why that comes into play is that if you are counting your inventory, you may have to count stuff that you've already shipped out depending on the shipping method, or you may have to count things that are on the truck on its way to you depending on the shipping method. We're not going to get into that in this chapter. This is just an FYI for you to read. But if you worked in inventory control or inventory costing or things like that, this would be something that you would definitely have to look at on a regular basis. Okay. Consigned goods. This is just telling you that if you have a company that has consigned goods, you actually don't count them in your inventory because you don't own them. And a lot of places we see consigned goods are for really high ticket items. So, for instance, you might see consigned goods for a used car dealership. So a lot of times when you walk into a used car dealership and you see a bunch of used cars on the lot owner actually may not own those cars. They may be just displaying those cards and selling those cards for the person that cars, and they are doing it for the person that owns it. And by selling those cars, they get a percentage of the sale. So they don't actually own the inventory. They're just kind of providing the sales and everything, advertising for the inventory, and then in return, they get a portion of the sale. You can see the same thing too for cars and boats, antiques, jewelry. The other thing is like really big now is like some women buy these really, really expensive handbags. I get mine at Walmart, so I wouldn't know, but like $500 handbags or something like that. So they have them resold in a consignment store. Okay. All right, we're not doing this one. We are going to start to look now at the cost flow assumptions. Okay. Now, I have a note here, a note here about boxes. At this point in the class, the boxes you have in Wiley Plus are going to be really important to helping you to kind of learn to figure out the problems. They've been that way already, but in some areas, they're going to be more help. And in some areas, you really have to look at where they're looking for you to put the answer. You really have to pay attention to where the boxes are for the answer, what the title is for that box on the top or to the side. Those all become very important. Now, a lot of people don't like using Wiley Plus, but there's two huge advantages. One is that you have those boxes. If we were not using Wiley Plus, you would get a blank piece of paper and you'd have to do it all on paper. And then you really have to know a lot more where you're putting things because you're not getting the guidance from the boxes, right? The other thing is that with Wiley, you're getting immediate feedback. If you weren't using Wiley, you'd have to email this, you'd have to submit the stuff to me. I'd have to grade it, get it back to you. By the time I got it back to you, you'd have to go on, it would just be a mess. You'd be on to another chapter. It would be horrible. So I just want to make a reminder to just kind of pay attention to the boxes. All right. So when we are talking about inventory costing, periodic inventory costing, which is what we're doing in this chapter, there are 4 methods. The first one is called specific identification. And then the next 3 are what we call cost flow assumptions. And the reason why they're called cost flow assumptions is because the costing method does not necessarily follow the actual flow of inventory. And we'll talk about that. But with specific identification, the cost actually does flow the inventory. So if we buy something for $10 and we sell it for $20, the cost of goods sold for that item was $10 because $10 is linked to that item. But in reality, what happens in the world is that we don't always pay the same price for the item. So like, for instance, Coca-Cola is an example. They might pay, so much a pound for sugar on Monday, and then on Wednesday, they might pay a totally different price for sugar. So what happens is that the cost flow assumptions are a method of looking at the cost of the inventory, the first that came in, the first that goes out, or the last that came in, the first that goes out, or the average costing method. So those are the cost flow assumptions. The inventory can follow the flow of the assumption, but it doesn't always have to follow the flow of the assumption. And that'll make a little more sense when we look at it. So if we were to look at costing flow, the most common in industry is FIFO, then LIFO and average costing, and then there are some other costing methods as well that we don't get into. All right, so the first one we're going to look at is specific identification. This is the one that will not be on your homework. This is the one that will not be on your exam, but we do cover it so that you're aware of how this works. And this might be something if you start a small business in your house and you are making customized t-shirts, say for people, you might do something like specific identification because you will have a very specific cost for each item. All right, so this problem says Crivets TV Company purchases 3 identical 50-inch TVs on different dates at cost of $700, $750, and $800. During the year, Crivets sold 2 sets at $1,200 each. These facts are summarized below. So you'll see below it shows the purchases, it shows how much the cost was for each purchase, and then it shows the sales on June 1 for the 2, okay? Now, with specific identification, you are matching the actual cost of the TV to the item you sell, or to the actual cost of the item to the item you sell. So here we're looking at an example of televisions, okay? So what they're saying is that Crivets actually sold the TVs it purchased on February 3rd and May 22nd. So the cost of goods sold are the one they sold on the 3rd was $700. The one they sold, or the one they bought on the 3rd was $700. The one they bought on the 22nd was $800. And so the cost of goods sold is $1,500. We see this a lot, like with automobiles too, right? If you go into a car dealership and you see 4 Ford Mustangs on the lot, right? All the same color. They might all have little different things that are very slightly different that changes the cost of that item and then the sale price of that item as well, okay? Here, they're selling them for the same dollar amount, but the cost to buy them is different, okay? Now, the other thing to look at here is that the ending inventory then is what is left, right? So if we wanted to know something called COGAS, cost of goods available for sale. The cost of goods available for sale is the cost of everything you have available to sell, okay? So the cost of goods available for sale for this problem would be 700 plus 750 plus 800. So that's what, 15, 2250, okay? So 2250 would be the cost of goods available for sale, right? Okay. The cost of goods sold in specific identification is the cost of the 2 items that were sold. And so here we have the 700 and the 800, that gives us the $1,500 sold, right? The ending inventory, there's 2 ways to get the ending inventory. You can look right here on the screen, you can say, oh, okay, the ending inventory is 750, right? Because 750 is the amount that they're showing there, right? But there's another way to get to know the ending inventory cost, and that is you take the cost of goods available for sale, that's what you started with, minus what you sold, 1,500, right, is what you sold. That means that I didn't mean to cross that out. That means you have $750 left, okay? You started with televisions worth $2,250. You sold $1,500 worth, so you have $750 left, okay? And this is the cost of goods available for sale is all the inventory. The cost of goods sold is what you sold. 750 is the ending inventory, okay? All right, so let me erase that and we will, okay, any questions about the, about that, you can let me know. All right, okay, so now we're gonna talk about inventory costing, the cost flow method. But before I do that, I am going to share with you a tool, and I want you to write this tool down. And you're going to look at this and be like, what? But this is going to be a very, very, very helpful tool for you once we get into figuring the problems, okay? And at this point, I'm going to share it, and I just want you to write it down, and then we'll talk later about how to use this tool. So let me share this. Okay, all right. So this is the tool, and you're going to want to have this when you get ready for your exam, and you want to have everything, including the image, okay? And you could just, do it scratch paper, that's fine. Okay, so number one, these are the questions you're going to ask yourself when you get into these problems, okay? Number one is what type? So what type do you want to know? Do you want to know FIFO, LIFO, or average costing? The second one is what do you want to know? Do you want to know the cost of goods sold? Do you want to know the ending inventory, or do you want to know both? Very important. If you want to know both, solve for the one the problem asks for first, then do the other one, okay? In order to figure out the cost of goods sold, you need to know how many units of each were sold and how many are in ending inventory, okay? Number three is you're going to find your direction. And number four is you're going to solve the problem, which involves several steps, okay? You're going to solve the problem that several steps. So you're going to want to write this map down. So we've got FIFO on the left side, okay? Cost of goods sold is at the top with an arrow going down. Ending inventory is at the bottom with an arrow going up. On the right-hand side, we have LIFO, last in, first out. And with LIFO, the ending inventory is at the top with an arrow pointing down. And the cost of goods sold is at the bottom with an arrow pointing up. What this means is that when we have a list of inventory, the first thing you're going to do is you're going to get the inventory into a specific chart. Once you have it in the chart, the cost of goods sold, the cost of goods sold is going to sit at the top of the chart, going downwards until you get to the number of items sold. And the ending inventory is going to sit at the bottom of the chart, from the bottom going up until you get to the number in ending inventory. It's the opposite for LIFO. For LIFO, the ending inventory sits at the top, and you're going to add down until you get to the number of ending inventory to get the cost. And for cost of goods sold, you're going to start at the bottom and work up with LIFO in order to get to the number of good items sold to get the cost of goods sold. Okay. Now, if you know FIFO directions or LIFO directions, the other one is opposite. So you just need to know one of them. However, this should all be on your notes for the exam. Yes, I'm sorry, go ahead.
I was going to ask the same question that somebody put in the chat about where the 450 came from.
Well, they're telling you that. The problem will either tell you 450, that's how much is in your ending inventory, or let's just say that they didn't. Let's just say they didn't tell us that, okay? All right? Let's just say they told us that 550 units were sold, and they want you to figure the cost of the ending inventory. The very first thing you can do before you can figure out any cost is figure out how many units are involved. So if they tell you started with 1,000 units and you sold 550, how many were in your ending inventory? 450. So you would subtract 550 from 1,000 to get 450, okay? This problem is telling you it's 450. The other thing is, let's say that the problem said, we want to know the cost of goods sold, okay? We want to know the cost of goods sold. They tell you, they have to give you one number. They either have to give you the number sold or they have to give you the number that are in ending inventory, because there's no way for you to get the other number unless you have one, okay? So if they told you that you started with 1,000 units, or you're going to figure out you started with 1,000 units because you're going to add up all these units that you put in your chart. And then if they tell you had 450 at the end, you would know you sold 550 because 1,000 minus 450 is 550. Okay. Does that help a little bit?
Yeah.
Okay. All right. Let's see. So, okay, we're going to go to the next slide here. Okay, next slide. All right. So the first method of costing, cost flow assumption that we're going to look at, and this is what we're going to be looking at today only, is FIFO, first in, first out. So I have a picture of a carton of milk down here in the corner because this is the best way to think about first in, first out. If you own a grocery store and you sell milk, you are going to sell the milk that comes into your store first, because if you sold the milk that came in last, then the milk that you got a long time ago is just going to continue to sit on the shelf and it's going to go rotten. Okay. So let's say you got milk delivered on Monday, Wednesday, and Friday. That's why if you look at the milk in the stores, in the display containers, they load it from the back and they push the oldest inventory to the front because they want to get what came in first, what gets pushed to the front, what came in first to be sold. First in, first out. So grocery stores will do that with everything because they're trying to sell their things before they go bad. Unless you have customers like me that go in and reach all the way to the back of the milk cabinet and get the newest milk. But for the most part, it's first in, first out. Okay. Now, not all companies follow that first in, first out rule, but they could use first in, first out costing for their method, even if they're selling textbooks or if they're selling, I don't know, whatever they're selling, okay? But with perishable goods actually do follow the first in, first out method of inventory flow. The inventory actually follows the cost flow assumption, okay? All right, so we are going to look at this. This is in the book. Don't look at anything on the bottom yet. Don't look at this bottom part yet, okay? Don't look at that. Just look at the top part, the top part here. This is, the top part here is what is in your book on page 6-8, okay? And we're going to be working with this problem and I'm going to show you how to figure it out. Now, in your problems for your test and for your homework, you're going to they're going to want an answer, and your answer is going to be like this. It's going to be a box, and they want to know cost of goods sold. Okay, that's all they want to know, cost of goods sold. They don't want to know how you figured it out. All of your figuring out is going to have to go on scratch paper. So if this was the problem and this was in Wiley, your box would look like this, and you would put in $6,200 because that's the cost of goods sold. I'm going to show you how you figure it out. But so you're only going to be putting in your actual final number, but you have to do everything on scratch paper. All right. So the top part shows what is called the cost of goods available for sale. Cost of goods available for sale. The total cost of goods available for sale is $12,000. The total number of units available for sale is $1,000. Okay. All right. So let's say that we want to figure out, let's see, are we going to do, okay, we're going to do the ending inventory first. Now remember, you're going to solve for whatever the problem asks you to solve for. And what they call this on the bottom, this little chart here, this is called the proof. You're proving your number is correct, okay? So I'm going to take you through how we're going to do this. First, I'm going to go back and I'm going to share the Excel sheet again really quick because I want to, we're going to look at that too, okay? The Excel sheet. Okay. So here's the Excel sheet, right? So first question is, what is the type? Okay, so we know we're doing FIFO. I told you we're doing FIFO. FIFO is the type, okay? Now that matters because we're only going to be looking at the left side of the chart below because we're working with FIFO. Since we're working with FIFO, we just pretend that the LIFO side does not exist, okay? We're working with FIFO. So what's our type? FIFO. Number two, What do we want to know? Well, I just told you we want to know ending inventory. The problems are going to tell you what they want to know. If they tell you you want to know both, you're going to solve for what they want, what they tell you first. So I'm going to tell you that we want to know ending inventory and cost of goods sold. So since I said ending inventory first, we're going to solve for ending inventory first. Now, in FIFO and LIFO, that doesn't really make that much difference, but when you get to average costing, it makes a huge difference. So you want to get in the habit of doing it now, okay? All right, the next one is to find your direction. And you're like, what? Find my direction? Okay, that's where the chart comes into play. So FIFO is our type, so we're over here on the FIFO. What do we want to know? We want to know ending inventory. What's our direction? We're going to count from the bottom up until we get to the number of units in ending inventory. We're going to count from the bottom up until we get to the number of units in ending inventory. Okay, so I'm now going to share the slide and I'm going to walk you through this, okay, on how we solve this. Okay, let's see. All right, so we're solving for ending inventory. The very first thing you need to know is how many units are in ending inventory. Well, we already know in this problem, they told us that there's 450 units in ending inventory. However, if we only knew that there was 1,000 units, and if we look at the top here, it says 550 were sold. If we take 1,000 starting number minus what we sold, 550, that tells us that 450 units were in the ending inventory. Okay, so now we're going to count from the bottom up until we get to 450 units. So what does that mean, counting from the bottom up? Okay, you're going to set up this little thing over here on the left-hand side, your little proof. You're going to set this up, and that's how you're going to count. So your first column is going to be your date. Your next column is going to be the number of units. The next column is going to be the unit cost, and the next column is going to be the total cost. All right, so what do we want to get to? We want to get to 450 units, right? 450 units. So we're going to look at the cost of goods available for sale at the top. We're going to count from the bottom up until we get to 450. Bottom up until we get to 450. Okay, so November 27th, there was a purchase of 400 units at $13 each for a total of $5,200. We're going to take all 400 units because we're trying to get to 450. Okay, so we come down here, we go November 27th, 400 units, $13 each, total $5,200. Now we say to ourselves, okay, we have 400 units. How many more do we need to get to 450? Well, we need 50 units more. We need 50 more units to get to 450. Now, if we look up above, we're going to see on August 24th, there was a purchase of 300 units. Well, we only need 50 of those. We only need 50. So what we're going to do is August 24th, we're going to take 50 of those 300 units times 12. So if we come down to our proof that we're doing, August 24th, we're taking 50 of those 300 units times 12. That makes $600. So now we have a total number of units of 450. That's how many that were in ending inventory. That's what we wanted to get to, was 450. And the total cost of that ending inventory using the FIFO method is $5,800. 400 units at $5,200 and 12 units at $600. So the total cost of ending inventory is $5,800. Now, since we know what we started with, the total cost of goods available for sale, $12,000, and we know that the ending inventory costs $5,800, we could very quickly figure out the cost of goods sold, because we know that the total we had available to sell was $12,000 to start with. We know that in the end, we had $5,800 worth left. So the difference between the two is the cost of goods sold. The cost of goods sold then is $6,200. And I'm going to actually walk you through how to do the proof for the cost of goods sold. All right, so now we know how we got the cost of goods sold. How we got the ending inventory, right? We know the cost of goods sold is the total cost of everything minus the ending inventory gives us what we sold. Okay. Now, we want to prove that cost of goods sold number is really $6,200. And the reason why we want to prove it, we do this on scratch paper, is because if we made a mistake in the ending inventory cost, the only way to catch it is by figuring out the cost of goods sold using the same method. Okay. All right. So to figure out the cost of goods sold, we're going to go back to that map for a second. I know this seems kind of crazy, but we're going to go back to that map for a second. We're going to look at the map just, as a reminder. We're looking at the map. Okay. What is our type? FIFO. We're still doing FIFO. What do we want to know? Now we want to know the cost of goods sold. What's our direction? We're looking at the FIFO side, right? Cost of goods sold is at the top. So we're going to count from the top down. See the down arrow? Top down until we get to the number of units that were sold. The number of units sold. Top down till we get to the number of units sold. So I'm going to share the PowerPoint here again, and we're going to go through and we're going to figure the cost of goods sold for this problem. We know it's $6,200. They already told us that, right? But we're going to prove that that $6,200 is correct. All right. So we're going for cost of goods sold with FIFO, you go from the top down, right? So we're using this top part here to figure out our proof, and the proof is at the bottom. All right. Let's do the first one. Okay. How many units were sold? 550. I told you that on the last slide. 550 were sold, right? 550 units were sold. So we're going to count from the top down until we get to 550 units, all right? So we're going to take the beginning inventory, January 1, 100 units at $10 each for $1,000. So down at the bottom, you'll see my proof. January 1, 100 units, $10 each for $1,000. Okay, so now we have 100 units. How many more do I need to get to 550? Well, I need 450 units more to get to 550 units. So I'm going to go to the next line down. We're going top down, right? April 15th, there was 200 units at $11 each for a total of $2,200. So I'm going to take all 200. April 15th, 200 units, $11 each is $2,200. So now I've got 300 units, right? How many more do I need to get to 550? I need 250 units more. So if I look up above on August 24th, I'm going to see there's 300 units, right? Well, I only need 250 of those. So I'm going to take 250 of those 300 units at $12 each. August 24th, $250 at $12 each. 250 times 12 is $3,000. Okay. I know now that I have a total of 550 units. 100, 200, 250 is 550. So I add up the cost of 1,000, 1,200, and 3,000, and that gets me to $6,200. And that is what we showed on the other page. So we just proved our $6,200 cost of goods sold is correct. Another way to look at the chart on the top is that if we look at this 300, remember that 300, we only took 250 of that 300, right? So if we look at that 300, we go, and we're doing FIFO. Now remember, LIFO is different. So FIFO, we know that 250 of them are sitting at the top sold, right? And then we know that 50 of them go to the bottom for ending inventory. Because that number splits. Part of it got sold and part of it was still in ending inventory. Okay? All right. Let's see. Okay, so one last piece of a slide here before we get into doing problems. So this is just showing you in a visual, if you actually followed the cost of goods, that the first that came in is at the top with FIFO, right? The first that came in is at the top and it goes out on the truck. And the last that came in is at the bottom. It's still in the warehouse. That's all they're showing you here. The image helps some people it doesn't. All right.